Good evening, dear students. We have seen the ratio part 1, in which we have seen the liquidity ratios and leverage ratios. Now it is the turn for computing the other categories like coverage ratios. In the coverage ratio, we calculate times interest earned or TIE. So it is also known as interest coverage ratio (ICR) or TIE. The formula here is EBIT divided by interest. So if we go to the spreadsheet, you can find here the EBIT divided by interest 4.26 times. Normally the TIE is calculated in times. That means how many times of the interest you are earning as EBIT. If you are earning more times, it is better. If you are earning lesser than your competitor, then you have to improve. Then cash coverage ratio. In the cash coverage ratio, it is like TIE, but in the numerator, we add back the depreciation and amortization. Why? Because we are not paying this to anyone. That's why in the numerator, with the EBIT, we add depreciation and amortization, we divide by interest. You can see here the depreciation and amortization is added with the EBIT, then divided by the interest. It is 6.21 times. Again, the more or the higher side you are, better you are than your competitor. 6.22 is the EBIT cash coverage ratio of your company. That is, Prufrock is earning 6.22 times of the interest as the EBIT and depreciation. Or we can call it as EBIT plus depreciation is also known as EBITDA. So the EBITDA is 6.22 times of the interest. Next category of ratios are the asset efficiency and working capital ratio. Now we finished three categories: liquidity, leverage, and coverage ratios we finished. Now we will discuss the asset efficiency, how efficiently you are using your assets, both current assets and non-current assets. Both how efficiently you are using the current, non-current, total. All three things we will see how efficiently we are managing. Similarly, how efficiently we are managing our working capital. All these things we will see in this category. The first one is inventory turnover ratio. Cost of goods sold divided by inventory. 3.4 times. So if you are higher in inventory turnover ratio, you are better than your competitor. Days sales in inventory. 365 days in a year divided by inventory turnover ratio. That is equal to 107.37. This one, lower is better. If you are lower than your competitor, you are doing better. So you have to compare your competitors, whether you are doing better or your competitor is doing better. Receivable turnover ratio. Sales divided by receivable. 12.29 times in Prufrock. Days sales in receivable. Again, 365 days divided by receivable turnover ratio. The first ratio is RTR, receivable turnover ratio, high is better. The days sales in receivable or DSR, low is better. Payable turnover ratio. Cost of goods sold divided by payable. Days sales in payable is equal to again 365 days divided by payable turnover ratio. Here we have calculated the inventory turnover ratio, number 1, then days sales in inventory. Receivable turnover ratio, days sales in receivable. Payable turnover ratio, days sales in payables. Then we calculated our cash conversion cycle. Cash conversion cycle is equal to days sales in inventory, we calculated in the previous slide, days sales in receivable calculated here, days minus days sales in payable. So here the cash conversion cycle is 49.53 days for Prufrock. The lower the cash conversion cycle, better you are. So while commenting on cash conversion cycle, you should not forget to see the cash conversion cycle of your competitor and industry average. So if you are lower than the industry average, you are better. If you are lower than your competitor, you are better. Or else you have to find how to lower this ratio. As we discussed in the beginning of this ratio, that is asset efficiency and working capital. So we have seen the working capital items like inventory, days sales in inventory, receivable, days sales in receivable. So ITR, days sales in inventory, receivable, RTR, days sales in receivable, PTR, days sales in payable. All these are working capital items. So how efficiently we are managing our working capital. Then cash conversion cycle. All working capital related things we have done. Now we will see how efficiently we are using our fixed asset, total asset and working capital. So these three we will calculate. Total asset turnover, fixed asset turnover, working capital turnover. Fixed asset turnover is equal to sales divided by fixed asset. Total asset turnover is equal to sales divided by total asset. Working capital turnover is equal to sales divided by working capital. All these turnover ratios, one thing very common, you can very easily, one of you asked me a question, how to remember or memorize the ratios. Here, no need to memorize. Any turnover ratio, any turnover, whether it is total asset turnover, whether it is fixed asset turnover, whether it is working capital turnover, whether it is receivable turnover, whether it is payable turnover, whether it is inventory turnover. Any turnover word is there, remember this trick. Any turnover is there, the denominator will be that particular ratio. If it is fixed asset turnover, denominator fixed asset. If it is working capital turnover, denominator is working capital. If it is total asset turnover, denominator total asset. If it is inventory turnover, denominator is inventory. If it is receivable turnover, denominator is receivable. Let me show you one of the see, receivable turnover, denominator receivable. Payable turnover, denominator payable. Inventory turnover, denominator is inventory. So any turnover ratio, denominator is the same ratio. Note down please. Numerator is either cost of goods sold or sales. Most of the places it is sales. Only two places it is cost of goods sold. In inventory, numerator is cost of goods sold. In payables, cost of goods sold is the numerator. See, in the payables, cost of goods sold is the numerator. All other places, numerator is sales. See, all other places, we will see numerator as sales. Total asset turnover, numerator sales. Fixed asset turnover, numerator sales. Working capital turnover, numerator is sales. So, all the turnover ratios, asset efficiency and turnover ratios, all these inventory, receivable and total asset and fixed asset and working capital, all these categories of ratio 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now all these 10 ratios, make it a point, your denominator is these 9, 10 ratios you will have, denominator is the same ratio. Inventory means inventory, payable means payable, receivable means receivable. Working capital means denominator working capital. Numerator, all the cases sales, two cases cost of goods sold. What are the two cases? One is the inventory turnover ratio, numerator is cost of goods sold. Payable turnover ratio, numerator is cost of goods sold. Reason why? Because they are arising because of the purchase. That's why we use the cost of goods sold. Now the next category of ratios are, once we complete the turnover ratios or the efficiency, asset efficiency ratios, we reach the profitability measure, next category of ratios. In the profitability ratios, you will have profit margin, that is net income divided by sales, EBITDA margin, EBITDA divided by sales, return on asset, net income divided by total asset, Some companies and some authors, what they do in the return on asset in the numerator, they add the interest in the numerator with the net income. And some authors, they directly calculate the net income. Here the authors calculated directly by net income. I have explained some authors also do it in the numerator by adding interest. So this is a kind of author to author, it varies. So if you are using only net income, your return on asset will be 10.11%. If you are using net income plus interest in the numerator, then your return on asset will be better, that is 14.04. Why this is? Because the assets are used for both uh, debt holder and shareholders. That's why net income belonging to the shareholder. Because assets are used for debt holders and shareholders, so in the numerator, debt holders take the interest, shareholders take the net income. That's why in the numerator, most of the authors they add both the things, net income plus interest divided by total asset. But whichever the formula you use, no formula is wrong. Both are correct. So in the spreadsheet, we have used both of them. Here, net profit margin, net income divided by sales, EBITDA margin, EBITDA divided by sales, return on asset, I have given a comment here. Some authors calculate by ignoring interest in numerator. Some authors calculate adding the interest in the numerator. Both the ratios I have calculated here. 10.11 is without adding interest in the numerator, and 14.04 adding the interest in the numerator. Both are correct, no issue. This author is using 10.11 without taking the interest in the numerator. Return on equity is net income divided with total equity, 13.99. So you can see the return on equity is equal to net income divided by total equity. All these are profitability. That's why we represent in percentage. You see, ratios are very important to understand this. Some ratios are represented as times, like all the, for example, inventory turnover, receivable turnover, payable turnover, total asset turnover. We have used in times, 0.64 time, 3.40 time, like that. 4.26 times interest earned. But once you come to the profitability ratio, you should represent in percentage. Net profit margin. Normally we talk percentage. How much percentage you earn net profit over the sales? EBITDA margin. Your EBITDA is how much percentage of the sales? Return on asset. How much percentage on that total asset? Return on equity. Your net income is how much percentage of the total equity? So profitability measures are represented in percentage. And normally, every company will expect high margin, whether it is profit margin, EBITDA margin, ROA, ROE. Every company will expect high margins on its sales and total asset and equity. So high is better comparing to your competitor and industry average. Now the last category of ratios, then we will go to the DuPont analysis, a special kind of ratio. Now the market value category of ratios. Here we see price earning ratio or PE ratio. Price earning ratio is price per share divided by earning per share. You can see for this company, all the details are provided here. Price per share is how much? $88. And number of shares outstanding is 33 million. Earning per share is $10.99. To the net income divided by number of shares outstanding is equal to earning per share. So $88 divided by 10.99 will be the price earning ratio. Price per share divided by earning per share. Price earning ratio 8.01 time. Next ratio is price to book value ratio. Okay, so here we have market capitalization. Either you can per share you can calculate price per share divided by earning per share, or you can calculate total market capitalization divided by total net income. The market capitalization, you know, the number of shares multiplied by price of share divided by number of share multiplied by earning per share. Both will give the same answer. Market to book ratio. This is the book value per share, the market value per share divided by book value per share. As the name itself suggests, market value to book value, market to book ratio. For this company, market value is $88 per share. Book value is how much is the total shareholders' equity we get from the balance sheet. Here is the balance sheet. The total shareholder equity of 2019 is 2591. 2591 divided by shares outstanding. How many shares are outstanding? Here we have seen the shares outstanding, that is 33 million. So here 2591 million divided by 33 million will be the book value per share. The total equity divided by number of shares outstanding. So 2591 divided by 33 million will be the book value per share. So market price per share divided by book value per share, 1.12 times. Market capitalization, price per share multiplied by shares outstanding. Price per share is 88 multiplied by shares outstanding is 33 million. So $88 per share multiplied by 33 million shares outstanding is equal to 2904 million is the market capitalization of the company. Enterprise value, it is another very important measure of the company's valuation. Enterprise value, how we calculate? Market capitalization, just above we calculated 2904 million plus bracket start market value or book value of interest bearing debt minus cash. Minus cash we do for net debt. Market value of the interest bearing debt minus cash will become the the net debt. To calculate the net debt, we deduct the cash. Why we have written market value or book value here? Normally debts are not traded for most of the companies. That's why whatever is the book value, that becomes the market value. Here interest bearing debt, we will take the notes payable also in the current liability. It is also interest bearing. That's why all the long term debt plus the notes payable we will add here. So the market capitalization, you all know market capitalization is 2904, we calculated above. So market capitalization is 2904 million plus the interest bearing debt. The 457 million is the long term debt, 196 million is the notes payable. If you go to the balance sheet, see the balance sheet please, go to the 2019 liability. The total long-term liability is 457 million plus notes payable is 196 million. So 457 we pay interest on that. Notes payable also, it's a credit arrangement, we pay interest on that. So 457 plus 196 will be the total book value or market value of debt minus cash. Cash is 98 million. So it is being done here. You see 2904 is the market capitalization plus the book value of all the debt interest bearing. 196 is the notes payable, 457 is the long term debt minus the cash holding of the company 98 will become the enterprise value of the company. EV multiple, a new ratio added to the market value ratio, enterprise value multiple, that is equal to enterprise value divided by EBITDA. Enterprise value you have calculated 3459 just now before, divided by EBITDA is EBIT plus depreciation and amortization, that is 876. So 3.95 times. This is the way we use all the ratios together. It is the liquidity ratio, solvency ratio, coverage ratio, asset efficiency ratio, and profitability ratio, market value ratio. All these categories of ratios are used together to interpret the company. Liquidity ratio tells you about the liquidity position, how quickly the company can pay the short-term liability. Solvency ratio talks about the long-term solvency of the company, how comfortably the company can pay the long-term liabilities. Similarly, the coverage ratios talks about the how many times of the interest the company is earning, either EBIT and EBITDA. Then the asset efficiency ratios talks about the how efficiently the company uses its working capital and its current assets, its current liability, working capital as a whole, total asset, fixed asset. That means how efficiently you are using your current and non-current assets. That we find from the asset efficiency ratios. Then the profitability ratio talks about how profitable the company is. And each category of ratios I explained you how it can be interpreted. Then finally we saw the last but not the least, we saw the market value ratios. In totally, we've used the financial statement analysis for making the kind of comparison of your performance with your competitor. I stop this video here. Let me stop the recording. In the next part, we will discuss about the DuPont analysis.